Hey folks, Dan Frio here, the rate update. Today is July 12th, 2021. What we're going to talk about next is forbearances. Some good news there. The housing market and supply is increasing. Good news there, and how those two tie together. And we're going to come back and talk about that next, so don't go away. There is a lot to unpack today. We got good news on forbearances, we got good news on home sales, and we got good news on rates. So let's dig into it real quick. The headlines right now are this, and this is, I'll be posting this here in a couple minutes as soon as we're done, is forbearance sees largest improvement to date. Okay, so what did I say back in about 6 months ago? And I say it basically every week. Guys, why is there no houses on the market? It's because of forbearances. And I don't know where or why nobody figures this out. If you haven't made a mortgage payment in a year and you don't have to yet, why would you put your house on the market and have to start making a mortgage payment or moving out of your house and having to rent? So that's what we're going to talk about. But first, I want you to hear what CNBC has to say about all this market data, and then we're going to unpack it in a minute.
For more than a year now, the housing market has been a perfect storm for sellers, but the winds may finally be shifting. Strong demand and record low supply are both starting to ease, and mortgage rates are coming down. New listings of homes jumped 4% in the 4-week period ending July 4th compared with the year before. That's according to Redfin. They were also up 3% from the same time in 2019, and that was the first time new supply topped pre-pandemic levels. The number of active listings still down 32% from a year ago, but that's actually the smallest annual drop since early February. Mortgage rates are helping buyers as well. They started the year at a record low, then spiked higher in March, and have now fallen back to the lowest level in about 5 months. Home prices, they're still nuts, up over 15% from a year ago, and that's why a monthly housing sentiment survey from Fannie Mae found that in June, 64% of respondents said bad time to buy a home, up from 56% in May. 77% said good time to sell, up from 67% in May. So as long as we see gains on that sell sentiment, though, we should see even more growth in new listings, which, Tyler, would in turn help those buyers.
Okay, great job, Diane, on your analysis of the housing market. So let's go back and unpack this. We have more and more houses coming up for sale. Why? Why all of a sudden right now? If you've been watching my channel, you know. Why is it forbearances? Okay, what is a forbearance if you don't know this? So what happened back in March of 2020 when the pandemic hit, the Federal Reserve and the central banks and everybody got together and says, you know, what are we going to do to stop a catastrophic event from happening like we did in 2006 through 8, where, you know, foreclosures just went rampant and so forth. So they came up with the CARES Act. Part of the CARES Act was a forbearance program that would allow homeowners and renters and other things, but we're talking right now about homeowners, to forbear or postpone their mortgage payment for a couple months. And then they changed that and updated and changed and updated, and they extended that all the way through in many cases through September of 2021. So that's coming up here soon. Many people, though, have lapsed through the system, and they had to come out in June and July. One big glut of homeowners came out in June. So what would happen is, once your forbearance is up, what happens now? You have to start making a mortgage payment. So if I'm in a forbearance from March of 2021 all the way through, and I keep pushing this thing out, and I don't have a mortgage payment, why would I sell my house? Because I have to do one of three things. I have to sell and buy another house, then I have a mortgage payment. I have to sell and rent, I have a housing payment. Or I have to sell and move back in with my parents, which I don't want to do. So what most people did is, when there's forbearances coming out and they're really struggling, a lot of people are going to put their houses on the market. Why I don't think there's going to be a housing collapse is because we've had a huge run up in values. In the past year, home values on average are up 15%. So a lot of home buyers aren't underwater. Plus, almost all of those homeowners had to, when they bought their house, they had to put some money down. There wasn't 100% financing like we had in the early 2000s. So that is all what's being absorbed right now. So you're going to see the housing market or housing inventory start to increase more and more and more. Okay, so that's what Diane said there. So now let's talk about the mortgage rates. What are mortgage rates going to do? And that's why you're here. So let's dig into this a little bit on this equation. So right here are the headline news, and I'll be posting this here shortly. Forbearances see largest improvement to date. Okay, so that basically backs up my claim that there's a lot of people in forbearance, and when they come out, which they did, ended July 6th, okay, you're going to start seeing more and more and more homes going on the market. All right, so now we see what's the economic calendar for this week? Well, let's first of all say, what's some of the biggest things that affect mortgage rates? Well, the Fed, and they control things and they monitor things. What do they monitor? Well, their two mandates, or what they're supposed to be in control of or try to control, is full employment, trying to get the most people to work as they can, and price stability, okay? And that means inflation. So people keep kicking the can on the inflation front, but I want to focus on that today because I still think, similar to this forbearance thing, is once the CARE Act's, all the benefits of that lapse, and that's supposed to cease in September, you're going to also have everybody that hasn't come out in July on their forbearance is going to end in September, okay? Then the other piece of that equation is the excess benefits that the government has been providing for unemployment is also subsiding. And one more piece of this puzzle is student loan deferment's going to end. So you're going to now have a house payment that you got to make, a student loan payment you have to make, and if you aren't working, you're going to have your benefits cut substantially. So what I want to focus here on is those two indexes, or those two numbers in regards to inflation and employment. All right, this week we have all the numbers coming in. The first couple days, Tuesday and Wednesday, we see a lot of information about inflation, the consumer price index and the producer price index. Okay, these 2 days here. Well, basically, a lot of people are like, well, yeah, okay, whatever. What are these anyways? Well, let's break them down real quick. Consumer price index, it goes month over month, year over year, and X food and energy. So what happens is when they're digesting these numbers at the government, they look at, for the consumer price index, how much consumer prices are going up. And what they basically use is it's a basket of goods, and you can basically just Google the consumer price index versus producer price index, and you can see it. So basically what they do is they have a basket of goods that they monitor, and it's right here. You can click it, and it's all kind of things such as food, clothing, toys, education, tickets to movies, ball games, funerals, haircuts. Look at all the stuff that combines in this, okay? So that's what it is. So what they do on this, in this basket, is say, okay, what was the prices from last month? What are the prices on that same basket this month? And what's the differential? Okay, so that is the month over month differential in the consumer price index. So year over year, they take it from last year to this year, which is obviously, so July of last year, and then they'll run it against the numbers in July of 2021, and how much have prices moved in that time duration. So the next piece of the puzzle is X food and energy, because they're like, people don't have to pay for food and energy, I guess. But they take out fuel and food and everything, and then they say, okay, with these components, what effect was there? And I get it, because oil is it fluctuates hugely, and it varies, but it's a part of our cost of living. So I think it should always be counted in there, but I'm not the government. The producer price index, however, is basically, think of it as on the producer side, all the components that it takes to produce a widget. For example, if you're producing a widget, say, and I use widget just a generic term, but if it takes copper, silver, and aluminum to make that widget, then what did copper, aluminum, and silver do from last month to this month? And that would be the producer price index change for that duration of time. And what were those numbers last year versus where they are right now? And that is the year to date. So there's the consumer piece of the puzzle, and there's the producer piece of the puzzle. Okay, so that's that part of it. So what I want to talk about here, though, is let's dissect these numbers on what's coming out. So I'll give you my feedback here in a second, what I think some things are, and I'm going to take an easy way out, and it's not the easy way out, but I'll explain. The consumer price index month over month, X food and energy, they're expecting it to be 0.7 increase. That was last month's. The consensus is they think it's going to be up 0.4. Consumer price index last month came in at 5 for the year over year. They're thinking it's going to be 4.9. The consumer price index X food and energy year over year 3.8. They're thinking it's going to be 4, and so forth. Okay, same thing with the producer price index over here. You got the month over month, year over year, blah, 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 blah. All right, so that's that piece of the equation, and that's going to be our inflationary checks that are going to be set in place by Wednesday. Do I think anything in here is going to shock the system? I do not. And honestly, I'm not really following these meticulously right now because there is a ton of volatility in this. And again, there's a lot of components to this that are skewing the numbers, okay? And for example of this, if you don't have the house payment and you don't have that student loan payment and you're making extra money from the government via your benefits, you probably have excess money to buy food, clothing, energy, and excess stuff. So they can charge more, okay? Also, what's causing prices to go up? A lack of labor, higher producer price index, or the components that it takes to produce these things. So right now, I'm really not following any of that. And I think the Federal Reserve finally said they're not going to do that as well. We're going to focus right now on the employment, getting everybody back to employment, because once that happens and the excess stimulus stops and all these housing projects and student loan projects go away, let's give it 3 or 4 months to see if everybody's spending patterns go back to normal. That's what I think is going to happen. I truly do think that. Okay, so that's what's happening in our charts right here. And then on Friday, we start seeing jobless claims and such from there. That is going to be more of a focus in my part than most, I think. And I'm going to address that probably come Wednesday, and then I'll start publishing those numbers Thursday and Friday as those come out. All right, so let's see what's happening to the market today. People follow me on a daily basis for this number right here, okay? Why do we follow this number? Well, basically, mortgage rates are tied to a bond or an investment on Wall Street. That investment is called a mortgage-backed security. So it is a bond that trades on Wall Street that's yield is the biggest component of your mortgage rate, okay? The Federal Reserve doesn't set this number. The markets do. Okay, so what's been happening though is the Federal Reserve has been stepping in and buying up mortgage-backed securities every month at a minimum of $40 billion worth of mortgage-backed securities a month. Why do they do that? Well, the number we just looked at, and we're going to look at in a minute, is what's going on to the price of the mortgage-backed security that is a bond that trades on Wall Street. Okay, how bonds work in its easiest terms is the more money I have to pay for a bond, to get a bond, the lower my yield or my rate of return. Okay, and I'm going to explain that to you here in its simplest terms. And I'm going to make this crazy simple. Let's say I have a coupon here or a bond that matures next year for $100. All right. So today I give you a high price for that. I give you $100 for that $100 bond. Okay, you're like, Dan, that's a stupid investment. Yep, but there's a purpose behind this. So in a year, my bond's going to mature and I'm going to get $100 back. If I give you $100 today, which is a high price, okay, high price. If I give you $100 today and you give me $100 back next year, what's my rate of return? What's my yield? 0. Because I gave you 100, I got $100 back. Okay, so the high price created a 0 rate of return. How about if I give you $50 today for that bond? So next year, right now I give you $50. Next year you give me $100 back. I doubled my money. I had a 100% return. I spent less money on that bond. That means my rate of return, my yield on that was 100%. So the lower the price, the higher the yield. Your yield in these cases is your mortgage rate. Okay, so that's how all of this works. So when we go back to this equation, we love when the prices go up and up and up. Look what rally we're seeing right now. So what's happening if we go back to the last quarter, we saw a pattern similar to this last May. What happened is the market rallied all the way up until the Federal Reserve met, And then fears of inflation and fears of everything else came into the markets, and it caused the market to crash. Right? This crash happened right during the week of the Federal Reserve meeting. Then what happened? Well, the chaos started to settle when we moved back up to basically almost where we were before, all that bad news came out. Okay. Well, the same thing happened running into into the June meeting. Okay. We rallied up. And then what happened? The week of the Federal Reserve meeting, everything crashed. Go back to my video. You should be more than happy to go back here to prove my point. I said, don't do anything. If we're going to rally back up to here, and I think we should stagnate right in about this region. Okay. Well, I was wrong, but I was wrong in a good way. Because again, what happens here? As the market rallies up, mortgage rates come down. So they're lower than I anticipated. Okay, so that's where we are right now. So what's my anticipation from here? Well, let's look at some analysis here. Then let's look at this what the intraday did, and then I'll give you my consensus at the end. All right. So we saw this rally into here, but there's all these technicals that we follow. So we follow these lines here, these red lines, and there's lines everywhere, and there's names for these things. But let's make it simple. These are what we call Fibonacci levels. These are ceilings and floors that are created in charting. And the nice thing is we broke this ceiling right here, but we didn't stay above it. So it created this short-term little ceiling right here. But the bad thing is last Wednesday, we rallied up to the line, but we didn't break it and stay there. But so that's where this line now comes into doubly play. Bad English, but let's go with it. And we kind of rallied back down through there. Okay. So the good news is we have room to move up to here. And the bad news is this line right here, or all these other squiggly lines, are 100-day, 50-day, and 25-day moving averages. They all play a role. Well, if you look at it, all of them basically dissect right in this region here. So if we look at it this way, we have a floor here and a ceiling here, short term. So what should we do? Well, if rates or prices go down, rates are going to go up, but only a little bit. If prices go up, rates have the tendency to come down, but not that much, only a little bit. I am saying, and I've been saying this for the last couple weeks, I think we should be trading at the 103.8 handle, which is right here. I think that's where we should be trading at. And we'll have some stability, kind of like in a region like this. Will we always be there? No, but we're going to change. We're going to swing between like let's see where we are, 103.53. Well, I think we might close around the 103.6. We're going to trade between a 103.6 and 103.8. What that means in just English is I see, whoa. Did you see that? While we were doing this, we went from a +9 to a -11. What's going on here, folks? Let's look at this. Man, we've had some dramatic changes while we're on here, but there's really no data. Let's go back to the economic calendar. Any data out today that should be affecting this market? No. So I don't know what that change just took effect. There might have been one just big trade take effect or something. But that's what's going on right now. This is why we do what we do. This is why I monitor this all day, every day. You saw it on your own that we went from a 9 up to 11 down. That's a 20-point swing. That's not good. I'm going to find out what the reason is behind that, and I will post that in an alert, or I will give you an update and do some major research this evening and check that out. Intraday, we basically stayed steady until just recently. So I'll find out that information for you guys and post that as a special edition this evening or first thing in the morning, so you guys aren't freaking out. So there's really no events that I know of that's taking place. Let's go back to CNBC Live and see if there's anything that just happened. Surge and more inflation stuff going there. I'm proving my point there. Forbearances, no. Let's just go to Yahoo Finance and see if there's anything there that that just happened hot off the presses that should make this move. No. Saudi Arabia drops Morgan. Nope, nothing there. So I will post a video tomorrow morning to explain to you guys what happened in a 20-point swing in the 5 minutes that we just spoke. So if you'd like to find out more about me and what I do in my team, and to also make sure you're following rates like this, because this differential in the rates, where from when I started posting this video to now, we might get a price adjustment of the rate might go up 0.1, 0.2%. If you got a $300,000, $400,000, $500,000 loan, that's a lot of money. That's why we do what we do. So to find out more about me and the Frio team, I'd like you to go to our website and our YouTube channel. But the first thing I'd like to ask you to do is please give us a thumbs up, subscribe down below, and hit the bell every time I post a video. You get an alert. If you're one of those ones in a forbearance, please don't do anything. Just call us. Just call us. We added the calendar leaf feature to our website. Again, I'll show you how to do that, to set up a one-on-one consultation with us to review your exit strategies there. But if you're building or buying a house, please reach out to us. We have extended lock periods in most of the country. We have a mobile app that beats the band. It is better than almost every system out there that I've ever worked with, and you can do everything by on the palm of your hand. And we my mortgage advisors, we have over 200 years in the business. When you add all of us together, we're a bunch of old folks here, and we know what we do, and we hope we know what we're doing, and we take pride in what we're doing. So that's that. So to find out more about me and my team, please go to, I'm going to go back to this web screen, our YouTube channel, The Rate Update with Dan Frio. We have over 900 videos here. You should find something that tickles your fancy. And our brand new website, therateupdate.com. There is a ton of stuff here. You can do all kind of things here with mortgage calculators and the whole ball of wax. Apply now, buy a home, refinance your home. You can check out, we have a blog down here that is really cool that you can sign up for and get on a daily basis to know what's going on in the market. But if you want to set up a consultation, what you need to do at this point is just hit meet the team. It's set up under my system right now for just to make sure it is working, but you can schedule an appointment right there. And when you click that, it'll go to my calendar. You can click any time available that I have available, and you can click it and it'll just launch the times I am available. Click that. You'll get an alert. You'll get a text. You'll get an email. I'll get an alert. It'll give you the opportunity to do this by phone or by Zoom. So that's the best way to do that. And if you want to apply now, all you got to do is hit the apply now button and then pick a mortgage advisor you would like to work with. If you don't know anybody here and you want to work with me, God bless you. Just click the apply now button and you are on your way. So that's it for today, guys. I'll find out what happened with mortgage or the bond yields here, and I'll post that as quick as I can. So don't go away. I'll be posting something here shortly. God bless, guys. Take care. Have a great day. I'll see you tomorrow. Bye-bye.